Welcome to the Lend Academy podcast, episode number 252. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's episode is sponsored by Lend It Fintech Digital, the new online community for financial services innovators. Today's challenges are extraordinary, with the upheaval affecting all areas of finance. More than ever before, we need to come together as an industry to learn from each other and make sense of this new world. Join Lend It Fintech Digital to connect and learn all year long from your peers and from the fintech experts. Sign up today at digital.lendit.com. Today on the show, I'm delighted to welcome Salas. He is the CEO and co-founder of Camino Financial. Now, Camino Financial is a really interesting company. They're a small business lender focused on the Latinx community. And as you'll hear in this interview, this is more than just a business to Sean and his brother, his twin brother and co-founder, Kenny. This is their life's work. And you can hear the passion in his voice where he wants to do everything he can to help Latinx small business owners. And we go into some detail about how he's doing that. We talk about the impact of the current economic crisis. We talk about how they're funding these loans and the typical terms that the loans have and the typical small business owner who comes to Camino for a loan. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Sean.
Thank you for having me, Peter.
My pleasure. So, I like to get these things started with new guests by giving the listeners a little bit of background. So maybe you can tell us what you did before you started Camino.
Yeah, before I started Camino Financial, my twin brother and I can never introduce myself without introducing my twin brother.
Okay.
We've been partners in life from the day we were born. And right before starting Camino Financial, we were both getting our MBAs at Harvard Business School. Mm-hmm. And we used that opportunity to incubate what today is Camino Financial. And before that, we were pretty much cutting our teeth on Wall Street in investment banking and private equity. Both of us worked for two of the largest minority managed funds with a focus on investing in minority entrepreneurs or communities with a high concentration of minorities. And so that's really where we got our backbone, so to speak, in business and really helped us propel what Camino Financial is today.
Mm-hmm. Okay, so it sounds like you incubated it, you had the idea while you're at Harvard, or tell us, where did the idea come from originally for the company?
Yeah, well, no, our story really stems back from our upbringing. Both of us are sons of an entrepreneur from Mexico that came to the United States in pursuit of the American dream. And I know that sounds very cheesy, but quite frankly, it's a story of many immigrants that come to the United States. And so, like an immigrant with very big dreams, my mom came to the U.S., and she saw entrepreneurship as the only avenue, given her limited educational background, to generate real wealth for herself, her family, and her community. Mm-hmm. And so she opened over 30 restaurants here in Southern California.
Wow.
Yeah, while pretty much raising 6 children. So my mom's super mom, but aren't all moms. Yeah. And so we grew up in that environment. Unfortunately, my mom did lose her business. It was like a house of cards that came crashing down after 25 years of very hard work. Kenny and I were 12 years old at that point in time, and my mom was devastated. So she decided, guess what? I'm going to remarry, move back to Mexico with my 2 youngest sons and restart my life. And that's effectively what happened. For a 12-year-old kid moving back to Mexico, that was pretty traumatic in its moment, but quite frankly, was a blessing in disguise. Mm-hmm. We grew up in Mexico from 12 to 20 years old, something that I think does reflect in the cultural and nuance of how Camino Financial does work today with our members. We came back to the U.S. in pursuit of that American dream. Once again, the cheesiness, but we got to relive that immigrant story. Mm-hmm. Coming back to the United States while we were citizens, and we are citizens, in a way, feeling what it means to come to a country in pursuit of something bigger than what you can achieve in any other place in the world. And so that effectively, laid the groundwork for what we ended up doing, going to UC Berkeley, then Wall Street, as I mentioned, and then incubating Camino Financial Harvard Business School.
So is it fair to say then that the idea really germinated, well before you even came back to the US?
Yes. It's so funny. My mom wanted us to be Mexicans, and I consider myself a Mexican American. Right. She really wanted to keep us in Mexico. But when you're a 12-year-old kid and you see your mom lose her business, there is anger that is born within you. And right. I'll never forget the day that we pulled out of our home in Hidden Hills. We were born in a way with that silver spoon, and it was taken away from us. Mm-hmm. And the entrepreneur in me was born that day. There's no question. So it was born many years before Camino Financial became a thing, and we called it Camino. It wasn't a light bulb moment where I was in a cold shower and, all of a sudden I need to help Latino businesses. No, it really stems. It's ingrained in my DNA, so to speak. Now, that said, I do think there were working on Wall Street, specifically in private equity and working for funds that had an orientation towards investing in minority entrepreneurs, which is always, as I mentioned, been a theme in my life. Mm-hmm. I felt that private equity as an investment vehicle is suboptimal to invest in Latino-owned businesses in particular. Right. Predominantly because while this market is big, the average size of a Latino-owned business measured by our research is about in the range of $200,000 in revenue per year. That's 1/3 of the size of non-Latino-owned businesses. And in private equity, we wouldn't invest in businesses that generated less than $7 million in EBITDA or profit, cash flow. And so private equity, of course, was catering to those very few businesses that are very large and made it. But the great majority, call it 97% plus of all Latino-owned businesses generate less than $1 million in revenue and skew towards that $200,000 range. Mm-hmm, mm-hmm.
Okay, so then El Camino means the way, right? Is that the translation?
El Camino means the way. Right. And so what we're doing at Camino Financial is simple. We're a fintech platform pioneering affordable credit to underbanked Latinx businesses, mm-hmm. which we quantify to be a $15 billion unmet credit demand in this market. Now, the reason why we use the word Camino deliberately is because we get it. Not all businesses are going to get the optimal interest rate day one, right? They're going to be charged in the high 20s, low 30s with our core product. And so what we want to do is help them build a path to more money over a longer term and at a lower cost. And so in order to create that path, we need to pair capital with an educational experience that enables them to formalize their business, develop a credit history, and quite frankly, get the paperwork in order so that they can then qualify for a lower interest rate loan.
Right. So let's maybe dig into that for a little bit. So tell us about the loan product. What's the range of interest rates? What's the typical loan size, loan term, that sort of thing?
So our core product is a microloan. So it's a loan between $5,000 to $75,000. The annual interest rates are between 25.5% and 40%. And the term, we start at 24 months, which is very unusual for our industry, by the way, as mm-hmm. you know. And we go up to 36 months. There's no prepayment penalty. So we've been able to benchmark our data. And so our average APR is 33.5% to make it comparable with other products at a 24-month term. Mm-hmm. The average APR that we've been seeing by competitors is in the range of 41.4% at 11-month term and with daily or weekly payments. So the net result of our product compared to benchmarks, it results in a 50% lower monthly payment with a Camino Financial loan, all things being equal on the loan amount given to the borrower. So we're really giving our borrowers a lot of cash flow relief. And fundamentally, what we're doing versus anyone else, we can talk about tech and AI, but fundamentally what we're doing better than anyone else is we're giving our members the benefit of the doubt. And if you don't mind, I'd like to tell you a little bit about our members and how they look like.
Sure.
So we're talking about members, 25% of them don't have credit history. The median account balance is $2,300 in their account at point of financing, and our average ticket size is $15,000. And there's a very large amount, I can't specify the percentage for purposes of their own security, are undocumented here in the United States. So when you even look at those terms and parlay that with the credit profile of our members that are truly thin file, cash-based, micro enterprises, not even small businesses. You're going to call that a micro enterprise when you're generating around between $200,000 and $300,000 in revenue per year, right? So these are micro enterprises, and you give these terms to them, it's like God sent. They're more than grateful, and quite frankly, that's just the starting point. Once again, our view is that while we think we're competitive day one relative to benchmarks, we think that we need to facilitate that Camino, that path to more money at lower interest rates and over a longer term.
Mm-hmm, mm-hmm. Okay, tell us a little bit more about the borrowers themselves. Like, what sort of businesses are they? What industries do they operate in?
Yeah, so the big industries are construction. That's about 26% of our business. Retail, 10% of the business. Transportation, 10.4% of our business. Restaurants and bars is about 9.6%. And then the rest is distributed between what we call broadly defined professional services. Sorry, when I say the rest, I mean the next big chunk is professional services. And they're your janitors, your landscapers that are serving the market.
Mm-hmm, mm-hmm. Okay, so I'm curious about this. Particularly, you said you got some undocumented workers. I mean, and you said a lot of them don't even have a credit history. So what data do you use to underwrite these people? And I imagine you can't just say yes to everybody. So
we can't.
How are you, maybe you just start with that. What data are you using when there is very little data available?
Yeah, so one thing worth noting is I do want to challenge the notion in the market that there's limited to no data available. These businesses do have bank accounts.
Right.
75% of them, of our borrowers, it's actually a bigger proportion for the broader market, but of our actual borrowers, the people that actually get loans, 75% do have credit history, maybe thin file, right? And so we can do a lot like other industry leaders with that data. Now, there's nuance to that data. Let's go back to the bank transaction data. I mentioned that the median account balance of a borrower at point of financing is $2,300. I told you the frequency of transactions in that bank account, it'd be a lot lower than what a lot of other alternative lenders are comfortable lending to, because they also want to see that transaction frequency. Mm-hmm. But there is data there, right? Once again, back to the credit, not forget about the credit score. We don't look at the credit score, but looking at the credit file, albeit thin, there is data there. We can look at credit utilization. We can look at credit history. And we can look at types of credit, et cetera. And so I think there is data there, not to mention you can get really fancy and look at the metadata of your application, evaluate the user journey. Usually that's better to use, not so much for the credit decision, but for fraud detection. And so therefore, there is data available. I don't want to give the notion that, because our audience are other people that are actively investing or alternative lenders themselves, they get it. And I don't want to give them the notion that the data sets are fundamentally different. Now, I do think given our specialization in the market, given the fundamental benefit of the doubt that we're giving in our market, I think how we cut the data enables us to risk rank our model for the thin file cash-based micro enterprises. And it's not Latino focused. One, we can't, and nor do we want to ever discriminate from an ethnic or cultural standpoint. But it's worth noting that thin file cash-based micro enterprises, there's nuance to that. And so by specializing, we're able to look at the data sets. I would say 80% of them are probably similar to that of other alternative lenders, right? And then we derive given our specialization, some risk-rating criteria that helps us derive a credit decision. Now, I will tell you something that we do that others don't do, Peter, is that given the cash-based nature of our business, we have to do something that's very prominent in emerging markets. But for X or Y reason, it's not, I don't hear it, or I rarely ever hear it here in the United States, which is a methodology called surrogate income underwriting. Now, surrogate income underwriting means you basically need to look at data sets and certain data points and derive from them what real cash is flowing through the business and the household. So, for instance, let me give you an example. I can't predict what Warren Buffett's net worth is based on the car that he drives. I think he drives a Cadillac. But when we're talking about evaluating credit for businesses at the base of the pyramid, right, you can, with a high degree of certainty, predict what the real cash flow is based on using different data points, because the disposable income is so limited for these demographics that you can make some really smart guesses. And based on that, not only can you make a credit decision, but more importantly, you can actually better understand what the capacity for repayment is for that given borrower. And that's probably one of the trickiest parts of this demographic, but we've been able to get really good at that. And once again, this is nothing new. It's just very prominent in emerging markets where you have an absence of that trackable cash flow data that we're used to having here in the United States.
Okay, so I guess what you're saying is one of the data points is what type of car they drive and how much that's worth. And so and then obviously a lot of these cars will have a car payment, and you can I imagine pull data on that information. But I'm just curious about that. I mean, you say that like the surrogate data is, I mean, really you're just trying to look for data anywhere you can get it. Is that sounds like what you're saying?
Absolutely. And then we'll be given our specialized view on this demographic, we're just going to use that data to derive probably different conclusions or different we're going to apply that data maybe in different ways than other alternative lenders are using it.
Right. Okay. And so how are these people coming to you? Is this all 100%? Like, I imagine I don't know, I presume you have an app, or is it all on the web, or do people come and see you? I know that in person. I mean, how do the people fill out applications?
So our application is 100% online and 100% tech enabled. Now, we just hit our 6-year anniversary about a week ago. Mm-hmm. And Peter, there were so many people that have been lending into this market for many years before we started that would laugh us out of a room when we told them we were doing a digital first, digital only approach with our market, that they needed to see you, they needed to touch you. And in the absence of that tact, that you would be able to earn their trust. Forget about the transaction piece. We can tech that part up. But the trust element is a critical piece of the puzzle in acquiring this market at a low cost to make the unit economics work. Because as I mentioned, our average loan is $15,000. Other alternative lenders are about $25,000 to $30,000. So we have to work with roughly half of what they're working with in terms of the earnings, at least on day one. And so what that means is that we had to go tech first. We had to be tech only. And what we found is that we were even pleasantly surprised ourselves that this market really has embraced a tech-enabled process, as long as we pair that with a very trustworthy brand. So I'm always a little embarrassed to tell people this, but Kenny and I did have our own mini-series on Discovery Channel en Español called Emprendedores, which means entrepreneurs in Spanish. We have created one of the largest bilingual content databases in the United States. And so if you Google préstamos de negocios, which is small business loans in Spanish, anywhere in the United States, we're going to be the #1 ranked website there. We're also ranking for other different terms that have nothing to do with credit, but have everything to do with helping businesses grow and be bigger and better than themselves. And so predominantly we saw an opportunity very early to not only be tech first, tech only, but also build our go-to-market strategy around that, and then embellish that with a brand and authority that gives people the trust that they need. Because if they don't trust you, I can tell you right now, if they don't trust you, they're not gonna transact online.
Right. So you're based in Los Angeles. So obviously you're lending in California. Where else are you lending in this country?
So we lend nationwide.
Okay.
We lend nationwide with the exception of New Jersey, North Carolina, Hawaii, and Puerto Rico. But other than those states, we lend nationwide. Now, not surprisingly, the three largest states that account for 55% of our volume are California, Texas, and Florida, in that order. And so those are very prominent states with a high concentration of Latinx businesses. But at the same time, it's worth noting that there are a lot of other businesses out there, right? 45% of businesses out there are also still looking for loans outside of those three core states. And they're fairly, evenly distributed. I would say probably, New York is a distant fourth place, but still worth noting, Illinois as well. But at the same time, when you look at the rest of the nation, you're pleasantly surprised to see the distribution. And in fact, it's worth noting a little bit of a plug on our research report. We release a quarterly Latinx small business survey based on the application data that designates an ethnicity. So we can't include the non-designated application data, but of the designated application data, we have about 27,000 applications, and we use that data to show the world where our businesses are distributed, what the average FICOs are, what the average revenue is, what are the trends in that data, and you can see that geographic footprint in that report.
Right. No, I've looked at those reports. I think you do an excellent job. Really provides a great service, I think, to the industry. So I want to talk a little bit about the current state of play, because you've been reading a lot in the press how we know small businesses are suffering. They say it's been Black and Hispanic businesses are suffering more. Those owned businesses are suffering more than others. So maybe you've obviously got a very good insight into the Latinx community. Why don't you tell us a little bit about how they've coped over the last 3 months?
Yeah, so just to share some stats, research states that about 91% of Latinx businesses won't be able to access the relief funds that are made available by the government. Forbes also had an article that noted that over 50% of Black and Latinx businesses expect to close their doors if the current environment withstands for the next 6 months. And so, yes, we were very early in raising the flag to the industry and to the government that Black and Latinx businesses are being left behind, not only in their small businesses, but also in healthcare and in systemic injustice. And so this is a very polarizing moment for these minority communities. And the call to action needs to be, hey, we need to not only acknowledge that and put data around the market so people learn about it, but we also need to create nuanced and specifically design products and services around these markets so that we can reverse this trend. And so to answer your question directly, yes, we are seeing our businesses hurt. I'm proud to tell you that our very quick response to this was leveraging that large content database and that team behind it and completely repositioning Camino Financial and its blog around a COVID hub, right. COVID and other relief resources hub, because it's worth noting, as I mentioned, that many of our members are undocumented. So we need to think broadly in terms of what those resources are, whether it's direct access to funds or other forms of relief that enable them to grow their business. So that's a narrative that we're hearing a lot, and I will underscore that narrative. Now, I do want to mention, Peter, that we also don't hear the second narrative as often. That second narrative is a narrative that Black and brown business owners are resilient. They are as resilient as any other market here in the United States. And let me explain why. The reason why they're resilient is, yes, we just went through, before pre-COVID, an 11-year expansion market. But the reality is that many of these businesses, these underserved businesses, right, have been living through many micro recessions in their own world. Right. Well over 80% of them operate in low to moderate income areas. The socioeconomic disparity gap has only amplified itself in these last 11 years pre-COVID. This is all pre-COVID. And so they know how to live in a recession-like environment. In fact, they don't just operate at the business level, they operate at the household level. And so the household helps subsidize volatility and cash flow of the business by, whether it's the wife, whether it's the kids, not only working for the business, but finding supplemental forms of income to subsidize the business at different points in times. The flexibility of these businesses, given how small they are, to reinvent themselves and recover from these very difficult points in time. And so I will note that while we are seeing a market that has predictably, unfortunately, it was very predictable, and I have a lot of articles on the subject well before people started throwing these numbers about 91% of Latinos and 95% of Blacks aren't going to get the PPP funding, and 50% are going to close their doors if this continues. Well before that, I was predicting that they were going to be left behind. But despite that, I think in many ways they also expect that and adjust accordingly. And it's worth noting that because, I know, one logical question is how many of your borrowers did get PPP, how many of them got idle funding. So, when we talk about that, I can tell you that, yes, many did not. I'm proud to tell you we're actually actively putting our own research together to show you how creating that content hub, creating that direct channel of communication with the market enables you to over-index in a substantial way in terms of those that do qualify for PPP funding, actually getting PPP funding. Anecdotally, I can tell you many of our members did get PPP or idle funding, and we're going to put some research out there to demonstrate how some of even the soft touches of education really make the world of a difference. It's not just around the PPP funding design, which does need some work, but also just being a real distribution channel of content and capital to enable them to take advantage of resources that exist.
Right. Because I see I'm looking at your website on my other screen here, and right in front of the center, you talk about the Paycheck Protection Program. You talk about other relief programs. You've got a whole section here. So you quoted this 91% number, but I imagine your customers was percentage would be much lower. I imagine, or those that are going to partake will, because they're, by definition, I imagine they're more educated and they trust you and they're going to look at what you've done.
That's exactly right. And so we'll be releasing more information on that in the coming weeks. But I can tell you anecdotally, based on the data that I'm looking at, that number is going to be a lot lower than what the market benchmarks are of 91% for Latinx businesses not receiving PPP funding.
Yeah. Okay, we're almost out of time, but a couple more things I want to get to. So let's talk about the other side of the equation here. And I read something about Goldman Sachs, but how are you funding your loans? Where's the capital coming from for these businesses?
Yeah, well, you probably won't be surprised, but we actually got our money from Mexico. We needed to get money from investors that are equally willing to take that leap of faith in the market. And so we found that money in Mexico. So Crédito Real is a publicly traded company in Mexico. It has a $2 billion balance sheet lending business, multinational, with assets not only in Mexico, but in Central America and in the United States across different lending verticals, including auto financing, payroll financing, and now small businesses. And so, starting at the end of 2018, 2019, they partnered with us, and we've really been able to fly since they were a critical part of our ability to really prove out the investment thesis in this market. And so, to date, we've lent over $60 million in loans, and we're barely getting started. Pre-COVID, we were on track to do, in the range of $100 million this year. And, very much like any other of these businesses, the market is big, $15 billion. So we still consider that to be very small. But in the scheme of things, we are the largest Latinx focused lender in the United States, and we are barely getting started.
So then, I'm curious about I imagine the loan volume's gone down as PPP, but with the crisis. But you've maintained a certain level of lending throughout, I imagine?
Yes, we have, but like the benchmarks that I've been hearing, volumes are down between 50 and 80%, and we're within that range.
Right.
It's hard to lend to businesses that are hurting, and we really need to recognize our swim lane. Our product is designed for a company that was growing, and these businesses don't need growth capital; they need relief capital.
Right.
Then they need recovery capital, which is at below market rates. That's not sustainable over the long run. But finding new ways of changing our capital structure and those participants in that capital structure so that we can give better terms to the market, even beyond relief, and we could qualify that as recovery. And so we're actively working on that, because the last thing we want to do is put our businesses at risk, especially during these times. And every day, all day, we're always about underwriting a loan for mutual benefit. And so we need to be very thoughtful and careful about how we deploy capital during these times.
Right. Okay. So as we look forward to hopefully coming out of this crisis sometime in the near future, when you look at what's on tap for Camino, what's coming up for you guys? What are you excited about?
Well, what I'm excited about, and if you don't mind, I'm going to share a very brief framework. The framework of our strategic thinking is that post-COVID's in 3 stages, the 3 R's. The first R is relief. The second R is recovery. And the third R is reinvention. And so as we think about relief, in our case, it's been a content play. Predominantly, some fintechs have been able to be PPP lenders themselves if they're of sufficient scale to be able to do it cost effectively. In our case, we did predominantly a content play. And then the second one is recovery, right? Recovery is really how can we design our products for below market returns? So work with different philanthropists, work with different players in the space that want to help this market, and then design our product around that recovery, rebuild capital, mm-hmm. I like to call it that. And so right now we're right in that stage. So we're actively talking about launching a recovery fund, actually in where you live, Peter. So I'll let you know as soon as we get that going. And so to really enable Latinx businesses, and particularly the undocumented that haven't been able to even get access to that relief fund, let alone recovery. And then the third stage is the reinvention stage. This is the part that gets us all really excited. I can tell you that reinvention is just going to amplify themes that we've been identifying for a very long time. The use of tech and AI in order to not only automate our processes to make better, smarter credit and fraud models, the need for transparency in the process and giving our borrowers the best market terms available, the importance and high burden of a marvelous UX, UI, but one that super serves specific market niches. But the fourth element that I'll talk to you about in the reinvention stage is really coalescing our stakeholders, right? Not just the alternative lenders, right? But the government, right? The private investors, and in my case, organizations called CDFIs, Community Development Financial Institutions. I think, as has been noted in PPP 2.0, there have been dedicated allocations to CDFIs to lend into the underserved markets that we're talking about. But there's been a lot of underinvestment in these markets the adoption to technology has been slow, with the exception of a few CDFIs out there. And quite frankly, it's been hard for us to become a CDFI ourselves. Now, I hope to announce in the next few months that we too will be a CDFI. But and then how can private investors participate in this process, right, as it relates to creating tax incentives in order to decrease the cost of capital? How do banks play a role? How do we modernize CRA, the Community Reinvestment Act, which was really designed for small businesses in the 90s, that really anchored around distances between branches, right, in low to moderate income areas. But quite frankly, as we're closing branches and even banks are digitalizing themselves, how do we modernize that? And so that's going to be an area of our focus at Camino Financial. And I do think there is a silver lining here. I even think the Black Lives Matter protests have really raised a lot of awareness on the need and disenfranchisement of Black and Brown communities. And I think these are the vessels, alternative lenders are the vessels in which we can enact that change. But we also still need to work with the government. We need to work with banks. We need to work with private investors to make sure that we can structure this capital and deploy this capital in very efficient ways that are nuanced for this market.
Right. Well, we'll have to leave it there, Sean. Best of luck. I'll be following along with your progress closely, and I wish you all the best as you grow your business.
Thank you so much. Thank you for having me. Okay,
my pleasure. See you. These are challenging times for any small business lender. Certainly, Camino Financial will be no different. But I do appreciate the fact that Sean is already talking about the recovery phase of this crisis. We did mention how Latinx business owners have been impacted in a dramatic way during the crisis. But he's looking at the recovery phase, and the fact that he's so ingrained in the community. It seems to me that he's got such a close ties with many of his borrowers that those are the sorts of things that are really going to hold him in good stead, hold Camino Financial in good stead as they emerge from this. And I think it's companies like those that really maintain a connection with their customers. The borrowers really appreciate the extra efforts they've gone. I think they're the companies that are going to come through this crisis well. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lendit Fintech Digital, the new online community for financial services innovators. Today's challenges are extraordinary, with the upheaval affecting all areas of finance. More than ever before, we need to come together as an industry to learn from each other and make sense of this new world. Join Lendit Fintech Digital to connect and learn all year long from your peers and from the fintech experts. Sign up today at digital.lendit.com.